Welcome to The Explainer. Today, we're going to pull back the curtain on one of the most important and maybe most confusing relationships in your financial life. Yep, we're talking about your financial advisor, and specifically how they really get paid. Because believe me, it can change everything.
So let's just get right to it. Is your financial advisor working for you, or are they working for their own bottom line? Understanding how they get paid is really the only way to figure out where their loyalty truly lies. Is it with you, or is it with their own paycheck?
You see, the core conflict, the real tension in the whole advisory world boils down to this. The advice that is absolutely best for you might not be the advice that pays them the most. And right there, that's the fundamental conflict of interest we're going to unpack.
Okay, so let's decode that paycheck. We're going to start with the two main ways advisors make their money: fee-only versus fee-based. Now, these terms sound super similar, I know, but trust me, the difference between them could have a massive impact on your wallet.
All right, check this out. It all comes down to one little word only, versus based. A fee-only advisor, they're paid directly by you, the client. That's it. No commissions, no kickbacks, nothing. Their only source of income is the fee you pay them. But a fee-based advisor, well, they get paid by you, but they can also earn commissions from selling you certain financial products. And that's where that potential conflict of interest really starts to creep in.
So what does this actually look like in terms of cost? Well, a fee-only advisor is going to use one of those top three models. Either a small percentage of the assets they manage for you, that's AUM, or maybe just an hourly fee, or even a flat annual retainer. Pretty straightforward. But a fee-based advisor, they can use any of those, plus that last one, commissions, a nice 3 to 6% cut of a transaction. And that right there is a whole different ballgame.
Okay, but it goes even deeper than just fee-only or fee-based. Let's talk about the hidden money makers. These are the places where those conflicts of interest can hide in plain sight. We're going to break down some of the most common ones you really need to watch out for.
First up, the most obvious one, commissions. This is pretty simple. An advisor gets paid a fee for buying or selling something for you, a stock, a mutual fund, whatever. The problem? Well, this incentivizes transactions, not necessarily performance. The more they trade, the more they get paid, whether it's actually good for you or not.
Next, we've got something called 12b-1 fees. Now, these are a lot sneakier. They're these little ongoing fees that are literally built into a mutual fund's assets, and a slice of that fee gets kicked back to the advisor who sold it to you year after year. It's like a hidden commission that just keeps paying out, quietly eating away at your returns over time.
And you might think, oh, 1%, what's the big deal? Well, it is a huge deal. Look at this. Over 30 years, a seemingly tiny 1% annual fee can slash your final portfolio value by almost 24%. I mean, that's potentially hundreds of thousands of dollars just gone. It's the difference between an investment growing 13 times over and one that only grows 10 times. That's a massive chunk of your retirement.
And last but not least, let's talk about proprietary products. This is when an advisor's own company creates and manages its own investment funds. Think about it. It's like a doctor who not only prescribes you medication, but also owns the company that manufactures and sells it. You have to wonder, right? Are they prescribing it because it's the best option for you, or because it's the best option for them? It creates a huge incentive to push their in-house stuff, even if there are way better and cheaper options out there.
The founder of Vanguard, the legendary John Bogle, he just put it so perfectly. The more the managers and brokers take, the less the investors make. It's that simple. Every single dollar you pay in fees is a dollar that isn't working for you, isn't compounding for your future. It's gone.
So, okay, with all these potential conflicts, how do you protect yourself? How can you possibly find an advisor who is truly 100% on your side? Well, it all boils down to one single standard. This is the litmus test. And that standard is called fiduciary duty. A fiduciary has a legal and ethical obligation to act in your best interest. That means they have to put your interests ahead of their own. It's not just a nice idea, it's the law for them. It is the absolute highest standard of care you can get in the financial world.
And this is where the rubber meets the road. The fiduciary standard means they have to find the best option for you. That's totally different from the much lower suitability standard. Under that rule, a recommendation just has to be appropriate or suitable. So a broker could sell you a high-fee mutual fund that's suitable, even if there's a much cheaper, better-performing fund right next to it. A fiduciary? They'd be legally required to tell you about that better, cheaper option.
Okay, so how do you make sure you're getting a true fiduciary? Well, arming yourself with the right questions is your #1 defense. So think of this next part as your pre-hire questionnaire, the 5 questions you absolutely have to ask before you sign anything.
All right, here's your playbook. Get ready. Question 1. How and from whom do you make money? 2. Will you act as a fiduciary for me at all times, and will you state that in writing? 3. What are all of your conflicts of interest? Please describe them. 4. Do you recommend proprietary products? And 5. Does anyone else stand to gain from the financial advice you give me? Their answers, and just as importantly, how they answer, will tell you everything. If they're direct and transparent, great. If they start dancing around the questions, that is a huge red flag.
Look, after all of this, if you only remember one thing, one single question to ask, what would it be? Well, it all comes down to this one fundamental question that just cuts through all the noise.
How and from whom do you make money? And don't let them off the hook with a simple answer like, oh, from fees. You need to get precise. Ask them, do you get paid commissions? What about revenue sharing from mutual fund companies? Any other payments? Make them lay out the entire money trail for you.
Because at the end of the day, their answer reveals everything. It shows you where their loyalty truly lies. It tells you if their incentives are aligned with your success or with someone else's.
And just a reminder, this is not financial advice. This explainer is for informational purposes only.